welcome to everyone who has joined us here in London today and to our virtual audience who is tuning in the thousands. I would also like to welcome Simon Cooper, Standard Chartered's CEO of Corporate, Commercial and Institutional Banking, as well as CEO for Europe and the Americas. Simon, you are joining us live from Singapore this morning, or your afternoon, and I know you're very sad you can't be here with us today, but you would like to say a few welcoming words and help us set the scene for the Global Credit Conference 2022. Take it away.
I am very sorry not to be there, but let me welcome all of you who just joined for the sessions that are being hosted out of London, and thank those of you who have already been participating in this 5-day session this morning. I hope you're finding them useful as you start to think about how to navigate the second half of this year. Clearly, the macro situation is top of mind for all of us at the moment, with Ukraine, global monetary tightening impacting the world economy. And that follows quickly, as it does, on the back of the pandemic. I think as a result of these, we've obviously seen commodity prices increase significantly, which exacerbates fears of global inflation. We've also seen global interest rate rises on fears of central bank hikes, inflation, and increased borrowing from corporate and sovereign issuers. So I can stand here today and be very tempted to say that these shocks are unambiguously bad for emerging markets. But actually, I see them in a much more nuanced way, widening the gap between the haves and the have-nots from a country-by-country point of view. So yes, there are definitely increasing challenges for certain economies and markets, but this creates opportunities for the more resilient and fiscally prudent economies. The war in Ukraine has definitely exacerbated what were already elevated food and agriculture prices, and they've raised risks around food securities. Many emerging markets import a significant percentage of their domestic food needs. Egypt, for example, I think imports over 80% of its wheat requirement. So that food availability and cost is therefore exacerbating the food crisis in a number of markets that were already struggling. I think this raises the spectre of both social instability and also political instability. The increase in food and energy costs is also putting pressure on governments to offer fiscal support to their populations to mitigate the surge in price for basic goods. And many governments already deployed significant fiscal support to their economies during COVID, leaving them very little ability to offer new measures. So we expect to see, therefore, an increased frequency of fiscal events and in applications for IMF or World Bank support. However, commodity price increases will also benefit exporters in places like the GCC, like Indonesia and Malaysia. The fiscal revenues that come from that will support their reform initiatives and support programs to help diversification from that typical dependency on commodities. This creates significant relative value opportunities when you look at exporters versus importers, or those who have versus those who do not have. If you look at China, we are seeing early signs that they are becoming more stimulative, if that's such a word, across the monetary, fiscal and regulatory fronts. Assuming that they get the COVID outbreak under control, I think there's real potential for an economic surprise on the upside in China in the second half of this year. So as we look forward, what we see, as I'm sure many of you do as well, the major risk is that the surge in commodity prices leads to demand destruction, that central banks continue to tighten monetary policy in the face of evidence that economies are slowing, which pushes the global economy perilously close to recession in the second half of the year. We're obviously putting this conference together and making ourselves available for the rest of the year to help you, whatever the conditions, whatever comes to pass. So with that, let me hand back to Lisa and an extremely knowledgeable group of panelists who can shed some light on these challenges, these opportunities. And let me finish by once again thanking you very much for joining us today.
provides the perfect segue into our first panel of today. But before we begin, a few very quick housekeeping rules. This session will be recorded and we will be taking audience questions throughout, which means that you can pop any burning questions you might have into the Q&A box on your device in front of you. Okay, let's begin. Joining me today to talk about these very volatile times and how governments, corporations, banks, and investors are adjusting to these headwinds are Katarzyna Kapela, Head of Funding at Raiffeisen Bank International, joining us live from Vienna. Guten Morgen nach Wien. Kofi Benzi.
Good morning.
Good morning. Kofi Benzi, Portfolio Manager at PIMCO. Laurent Christophe, Group Treasurer and Head of Investor Relations at Trafigura. Rajan Bagri, Managing Director, Capital Markets, Financial Institutions at Standard Chartered, and our host of today, Henrik Graber, Global Head of Credit Markets at Standard Chartered. Welcome to all of you. Henrik, let's begin with you. I don't want to age you here on stage, but I know you have been in credit markets for quite a few decades. So against this very dramatic backdrop that Simon has outlined to us, what are some of the most, let's pick the three most transformative trends you are seeing in credit markets today?
Thank you, Lisa, and welcome everyone to the conference. I think obviously it's been a few challenging years, which started with COVID, and now that's accelerated to new issues globally. Our investors and issuers, managers have had a tough time in the markets, but overall I think the markets have proven to be very resilient, and actually the infrastructure supporting markets have been very resilient. I think 2022 clearly has gotten off to a challenging start. Many EM funds are reporting about minus 14 to minus 17% at the half-year point. So looking forward, in terms of what I think the top three issues are going to be, first is the one that Simon mentioned, which is inflation. We're clearly having a very significant inflation shock. That's going to impact rates, FX, commodities, and also the credit markets. From my own opinion, I think we're moving slightly beyond the inflation discussion, more to a recession discussion, which may also be somewhat of a light at the end of the tunnel. However, for credit, you have the added strains on the credit burdens because there's been a lot of debt raised that a slowing of the economies could do. I think a second theme around inflation that's very important is the increasing rise of inequality. The inequality index that Bloomberg has from 1967, I believe, is now the highest it has ever been. And I think one of the two things that will happen around that, firstly, there's been talked a lot about staple food prices, which I think is going to be a real challenge that's already impacting 190 million people and is probably going to get worse in the second half. But secondly, for emerging market companies and sovereigns, given some of the debt loads, I think in the second half, we are going to see issues around, for example, DSSI or debt relief and debt transparency be a much stronger theme. In terms of my second theme, I think is ESG. What we have going on now around supply chains and demand for commodities and carbon may change the pace of ESG development, but I don't think it will fundamentally change. Renewables are here to stay. We're going to continue to see deep investment into renewables. But I also think ESG is going to continue to broaden into other areas. One of those is around governance. So greenwashing is going to be ever more important. But we're also going to have other areas of finance. For example, gender finance, I think, will become a much stronger theme in the coming years. And the last pick from me, number three, would be infrastructure. I think infrastructure is going to be a very strong theme globally. In emerging markets, we're very used to infrastructure investment, project finance, building of ports, hospitals, energy, but I think it's going to become a global theme. And with changing supply chains, the potential of more localization and less globalization, infrastructure globally, including developed markets, I think is going to be a really strong theme and a very exciting area to invest in. It also, through infrastructure, you can have access to both equity through the debt in different tranches and different formats, exposure to different sectors. So in summary, I think it's been a really resilient 3 years. Market participants and infrastructure has performed incredibly well, although it's been tested to the brink at times. But I think there are some fantastic opportunities. And I personally think the second half will be better than the first.
Great. Katarzyna, I would like to bring you in on the conversation now. You are based in Vienna. You work for Raiffeisen Bank International. I mean, when we spoke, you mentioned to me you have staff based in Ukraine, in Russia. So clearly and obviously your business is massively impacted by what is going on, not very far from you. So how are you dealing with such a crisis, and have conversations you're having with clients, with investors, have they changed?
Yes, they have. Thank you, Lisa, first of all, for having me here with you. I hope you hear me well. As I hear that there are some thousands of people dialed into this panel, I would maybe give a few words about our background and the footprint of RBI. So as you said, we are headquartered in Vienna. We are majority owned by the Austrian Raiffeisen sector, which is a cooperative system. We have a market share in Vienna or in Austria with deposits in Austria of 34%. So we are like the strongest deposit taker in Austria. We have a very strong base here. We as RBI are oriented internationally at big corporates in Austria and outside Austria. But as you said, yes, we are through 14 subsidiaries also very strongly linked, and we built up a very strong brand in 14 countries in Eastern and Central Europe, and 2 of those are Russia and Ukraine, and also then Belarus. We are covering in this area around 18 million of customers, and we are there for more than 30 years. So we really have a strong record there, and we are top 5 in 11 of our countries out of 14. So we are pretty strong there. And yes, as you're saying, the crisis or the war in Ukraine has hit us really to the core of our business model. So a little bit maybe about these 2 banks that we have. So in Ukraine, we have the 3rd largest bank, which employs more than 6,600 people, and we operate 389 branches over there. So it's really, we are responsible for many people and their families in Ukraine. We booked there around 2.2 billion of assets. And coming now to your question, around 400 million of this 2.2 billion of assets are booked or are located in occupied and detected areas. Before the war, our non-performing exposure was around 1 to 2%, so very low non-performing loans. This 400 million will be very much affected by the war. What I have to say, despite the war, our colleagues in Ukraine are doing a great job under really unimaginable physical and mental strains. At no time since the beginning of the war, we had to suspend our operations in the country. We have all our normal banking operations maintained. We have, on most of the days, around 300 branches opened out of, as I said, 389 branches. So most of our branches are operating and providing services to the customers in Ukraine. We have cash in transit and ATM restocking all the time working and sustained. So everything is working in Ukraine as well as it can be. In Russia, we own the 10th largest bank with around 10.6 billion of total loans. So we are number 10 in Russia and one of the biggest foreign bank, which where we built up over more than 20 years, really a very strong brand. And we've been very successful, as you mentioned. But the war, the sanctions, and the deterioration in business relations really mean that we need to reconsider many things. So as we have announced, we are reviewing all options around our Russian subsidiary. from regulated downsizing to sale of the operations. But unfortunately, for me at least, there was no decision taken so far because it's, the analysis is still ongoing and we are evaluating all the options still. But what we are doing in the meantime, we are focusing to ensure that the bank remains very well capitalized, very liquid, and that it can maintain its excellent operations. So on the capital side, we have a total capital of 16% with a good buffer of 4.5 percentage points to the regulatory requirements. So very well capitalized. We suspended new lending in Russia, so we are downsizing the operations. This is also very much benefits the liquidity. Besides that, we have also stable deposit inflows in Russia as a foreign bank, which brings our LCR in Russia to more than 230%. So very good liquidity position, capital position still. And I have to highlight that we have absolutely no obligation to provide any fresh capital or funding to this operation. What have we done besides that to navigate and to move? And you can believe me, the discussions with investors were very tough, and we tried to be very transparent. I think our first press conference and our first investor call we had already on the 1st of March to give people information, to have transparent information out there, what we are doing. So what we have done, first of all, we have for many years a very strict limit allocation and concentration limits on Russian customers. This is exactly precisely for the times like now. From 2018, we have implemented a watch list of customers, Russian, Belarusian customers that could possibly become subject to Western sanctions. And by no accident, we have only 3% of our assets in Russia and Belarus under asset freeze. So very, very small limited amount, which is, I think, around 600 million or even below that. We have reduced also our cross-border lending immediately. We are now below 400 million. So the cross-border lending to Russia from Vienna. We have immediately downgraded our Russian and Belarusian exposures or the countries to one notch above default, the same for Ukraine, one notch above that, which have led to many downgrades of customers with the country ceiling. We did a review of most of our corporate portfolio for second round effects, and we have reviewed in addition 2,500 ratings within our group, which are somehow linked and exposed to sanctioned entities, which makes us believe that we have taken most of our risk-weighted asset inflation into first quarter. So we believe that smaller amounts will materialize in the following quarters. And we have also suspended our dividend payments to buffer our CET1. So we have done a lot to stabilize our position. That's, I think, part of a very long answer to your question, Lisa. But there was so much happening in RBI, and we did so much. And as was mentioned already, luckily we were from one crisis to the next crisis. We had still all our procedures in place. And it's, it's like a fire test. The more often you do it, the better you become, apparently.
It certainly sounds, sorry to interject, it certainly sounds like your crisis management strategy is a very solid one. And we can probably all learn a little bit from that. If you don't mind, I would like to move on the conversation just a little bit. We're still going to talk crisis. I mean, how can you not in the current climate? But let's have a look at how it is impacting trade and supply chain, especially in emerging markets. So, Kofi, I would like to bring you in on the conversation here. Global trade fell by around 2.8% in February and March alone this year. And I mean, you are a fund manager. You are an expert on emerging market credits. So tell us, how is that all impacting emerging markets as an asset class?
I should probably set the stage and say she oversold my abilities quite a bit there. I think, especially in this current environment where I think we're all baffled by what's happening in front of us. I think that the problem when you look at it is actually that, and I was listening, and obviously to Henrik as well, and you just think to yourself, when you take a step back and you actually look back, we've actually survived an incredible crisis for the last 3 years. So that's probably the first point. And I think that when you look at the performance you've seen this year, which sounds terrible by all measures, there's a lot in that number. So I think we should take a step back, take a big deep breath, and recognize that. I would say that I thought Henrik was very positive about what we expect for the rest of the year, and I think that when I hear that, I take a deep breath, because I also think that there's so much that we still haven't experienced for the next 6 months that it's hard for me to be too, despite my bias to always be a little bit confrontational. It's hard for me to be too confident going forward because there's still so much we need to go through in terms of the problems with the supply chain, the problems with inflation still have to feed through. What we're seeing in Russia and in Ukraine has yet to really feed through to prices, and so that's what makes me a little bit anxious. I wouldn't say I'm in emerging markets per se from a company level or corporate level. We really have as much visibility on the supply chain issues. I think actually he'd be far better able to speak to this than myself. We're not seeing this in the numbers yet. I think the companies in general we speak to feel quite confident about their position going forward. I think there's really more on the DM side where they are having to manage supply chain issues, because that's much more of an industrial segment part of the equation, whereas we on the emerging market side are much more of a commodity exporting side of the equation. So really from our perspective, this is almost, I wouldn't say it's a good crisis to be in, but it's not necessarily the worst crisis we've been in. It's probably the better way to put it. So, if you look at the emerging market as sort of a commodity exporter, this isn't the worst environment. I think the problem, and I think Henrik highlighted this very clearly, is we do have a problem in terms of, and it's a benefit, but it's a problem in terms of there are other emerging market countries that are importers. They're natural importers of goods. Even if they might be exporting raw materials, they're importing processed materials. Again, very good. Very good position for him to be in. But unfortunately, that is the challenge we're suffering through when we look through an emerging market. When I look at when you take a step back and say, how does that relate to performance for the rest of the year? And I think that's really where you're going with the question. The bias would be to say that if you're down 14 to 17% at halfway through the year, it'd be hard to really get much worse than that. I think that, and I think we can probably pray to that. I think that the real problem is the fact that there's so much in that number that we're really not factoring in. We've never seen a situation where interest rates have moved so much on their own. We have expectations of inflation of 8%, and we're expecting to see short-term rates get anchored around 3% at some point. So that's what's really dulls how much of the performance, what that 14 to 70% really means. And to be frank, that just says to me that number overstates what we've actually been through. We have to realize that really what we're having is a real repricing in base rates. That's a very important factor that probably hasn't finished yet. And really, you have to think through where we are in inflation, what the Russia-Ukraine crisis really brings to in terms of how, what inflation expectations have to be going forward if we continue to expect commodity prices to keep readjusting. And the supply chain issues are probably a secondary issue, to be frank. I think that's probably a stage 2 as we see companies onshore. So I think that to put more around a point on it, I think that we have, I think that it's really challenging, yes. I think we have to look through the segments in terms of where we want to be invested in, and really take into account that duration is really driving the performance more so than anything else on the one end. On the other end, we have a real bifurcation in terms of I would say, to make it simplistically, investment grade versus high yield. It's not a fair description of the situation, but I think it really explains a lot of the performance, because a lot of the performance we're seeing is really anchored, weighed down by the underperformance of the high yield segment. And really that's been the problem. If you separate out and look to a more investment grade sort of platform, let's say corporate credit in emerging markets, it's done relatively well. Duration impacts taken aside. It's really what's happening, what's really anchoring us down is actually the lower end of the sovereign spectrum, which is really anchored by the weight of COVID that's really suffering another crisis going forward.
Good.
Doesn't sound very good.
Sorry. Well, I was just going to say, I'm glad you think that we have hit rock bottom and that's now only one way. That's what I heard.
Hopefully that's not
And there's only one way for it to go up. So we can't really talk about 2022 without also talking about the global energy crisis. And Laurent, I would like to bring you in on the conversation here because you work for one of the world's leading commodity traders. And I was just curious, I mean, what is your take on all of what's going on in the markets? I mean, Europe, we're here in London. Do you think, the energy crisis is completely derailing Europe's ambitions to move to net zero? What's your take?
Yeah, no, I think working at Trafigura, we've been in a prime spot to observe what has happened to the world. I think it's been obviously a very interesting moment. We've seen massive volatility in commodity markets to the tune we've never seen before. So interesting times, but it's really a watershed moment where you have realignment of production, distribution and consumption of commodity globally. The energy transition obviously is a little bit exacerbating the situation because you're pulling out the second largest producer of oil, of gas out of the market. So you have today a significant deficit in energy products at a time where Europe is looking at shifting its security policies away from the dependence of Russian gas and fossil fuel. Obviously you had significant underinvestment in fossil fuel for years. With ESG, it was not so fashionable to invest in oil field projects. You had companies like Shell, BP, which have publicly said they're not going to grow their production in oil. They're investing in renewable instead. So how do you fill the gap, right? That's a big question today. Where is investment going to come from just to ensure that we can continue to consume energy the way we've been able to do so? It's always a balance between, on the energy side, between like security, affordability, and today decarbonization. And I have to say that unfortunately, decarbonization is taking a little bit of the back seat right now compared to affordability and security. I mean, government will have to ensure that people literally can switch the lights on, over the next few months. So it's really a watershed moment. So I think the title of the conference was definitely well found. And we as a trader, we have a few concerns about disrupted commodity markets. We're seeing dysfunctional derivatives market and physical and derivative markets are like the yin and the yang. They need to work together. Today we're seeing a drop in open interest in the commodity future markets. We have, I think it's about 25% decrease in open interest compared to the last 5 years. And if commodity traders are not able to hedge their physical position, effectively they will have to reduce their volumes, which means the role we play, which is to balance global supply and demand, is broken. all could be broken. And what does it mean? It means like more inflation, higher prices at the end in commodities. It's obviously not what we want, but cost of capital will increase. And if we're not seeing like investment in oil and gas alongside renewable, there's definitely some issue down the road on more volatility. Volatility is a good thing for commodity traders, but as we've seen, too much of it is actually kind of dangerous.
Okay, thank you so very much. I would like to remind the audience here in the room as well, dialed in virtually, please do submit any burning questions you might have into the Q&A box. I've got one here, which I'm saving for later, but if there are any other ones, please pop them into the box. Let's deep dive into inflation and interest rates. It has obviously come up quite a few times, and Ranjan, this is your moment to kind of join the conversation, please. I mean, you work for Standard Chartered. Your bread and butter are banks. I mean, you speak to banks all day long. Probably not too much, but a lot, I would imagine. And so I'm wondering, what is the impact of all of this on European banks' balance sheets? And are these rising interest rates, are they a good or a bad thing for the banking sector?
It's a really interesting question, and I hope the answer is just as interesting. The truth is that you've got to think about it in both short term and kind of medium term. I'll take a view on the short term and the medium term. I mean, the first point has already been mentioned by Henrik, is it is a watershed moment for inflation. Everybody can agree to that. It's the easiest question to answer, I think, on the panel today. 40-year high in inflation in the US, in the UK. I think the print last night was 9%. That means, to my mind, real inflation is easily in the double digits already. It's something which we're in now, and we've talked about for a long time, but we're definitely in it. For banks in the short term, a rising interest rate environment is positive. It creates an opportunity. We've had 15 years or at least 13 years of very, very low interest rates and net interest margin compression pretty much universally. So we're now at a stage where banks can get a little bit of relief from that, and that's clearly a positive for the sector. And when we think about that, again, it's not universal. So if I think about, I'm talking about European and US banks. US banks are actually particularly well positioned for that in the short term, because what you found over the last couple of years was that the deposit base of US banks, about 25% of that was made up in non-interest bearing instruments, so non-interest bearing deposits. So it's a pretty good guide that you're at a frothy stage of a cycle when, depositors are prepared to put money at zero interest with banks. And what that means is those banks, given the liquidity in the system, what a bank's going to do in the short term is it's going to allow deposits to roll off, and it's going to reprice assets. And so clearly you will get a net interest margin benefit from that. But then that will only last so long, and then eventually the lag effect will catch up. In the medium term, the truth is that significant and sustained inflation creates more economic risk, and banks, are wholly subject to the economies they're serving, and so that risk will transfer to the sector. You will get higher credit impairments. We mentioned that this is turning into a recessionary environment quite quickly. The rate of that is certainly up for debate, but it's no doubt that's where we're heading. And that's clearly not positive for the sector. And it depends on your view. I mean, if you've got a really, really bad view, sustained inflation over the long term is particularly terrible. If you're talking about it over a medium term, it's perfectly manageable. The good news is that from the banking sector's perspective, we really couldn't be arriving at this moment in any better health. And again, the word crisis has been used far too many times on the panel already, but I'm a believer that crises don't end, they just get usurped by new crises. And that's exactly what the banking sector's been through, since the global financial crisis. So why is the banking sector in a good position to deal with this? Well, one of the kind of unwritten stories of the pandemic was that a lot of the risk, the credit risk, the bad loans that would have been absorbed by the banking sector was actually absorbed by government liquidity schemes. And so if you look at NPL ratios among the European banking cohort, on aggregate, they're about 2% at the moment, and that's the lowest they've ever been since they've been recorded, probably over the last 10 to 15 years. So the balance sheets are relatively clean, and that's a good thing. Ability to absorb losses is obviously, dependent on that. And then if you look at the capital levels of banks as well, again, we're not quite at, but we're near all-time highs. So post-crisis reforms, from the global financial crisis. Obviously, one of the major tenets of that was to increase capital levels, and we're about double where we were when Lehman collapsed. So the European banking average is about 14%, and that's versus a requirement of somewhere between 9 and 10%. So there's a huge buffer over where the requirements are. So this is very clearly not a banking crisis, and that's good news for everybody. But at the same time, it's nice to know that banks are not the story, but at the same time, over the medium term, it's fair to say that we will see that. And it's just like any industry, you will have winners and losers. Any overly sectorally focused banks will certainly suffer. Although again, a lot of the post-crisis reforms, which are generally, as you move further away from a crisis, it's easy to talk about how bad the regulators did. The truth is that, I actually think the regulators did a pretty decent job in a lot of ways, and that, the health of banks today and the ability to withstand that means that you're not talking about contagion effects and all the things that we've, kind of grown up in the industry with. So I feel quite positive about that. My bigger concern, actually, as was raised earlier, is inequality, because that also feeds through the banking sector. That's obviously a huge social issue, and the haves and have-nots, will only be exacerbated in a recessionary environment.
Thank you so much. We've had some interesting audience questions come in, and I was wondering, Katarzyna, whether you would like to rejoin the conversation here with us in London. Someone in the room here had a question that relates to central banks. So I wondered whether you want to take a stab at it. And the question goes that the person feels that market and economic cycles are becoming shorter. So is there a risk that central banks might have to reverse their tightening policies as soon as next year, as soon as 2023? What's your take on that?
Yes, I also feel that there is a risk from 2023, 2024 latest, as inflation is forecasted to go down again. And we are, as said before, we are facing recession. So there must be a balance between fighting inflation and preventing recession. So yes, I also feel that that might be a short period of increasing interest rates, at least in Europe. Yeah.
Thank you very much. We have a question on emerging market credit. Kofi, I think I would like to bring you back into the conversation here. Question also from us here in the room is, with the performance and outflows in emerging market credit markets, how and what do you feel about refinancing abilities of sovereigns and corporates, and where do you see the biggest vulnerabilities?
Deep breath. I think this is probably the issue, is that if you separate the market out into, if you look at the separate out the market into, let's say, fixed income, and you look within fixed income at sovereigns versus corporate credit. If you look at the credit, the external market, the external sovereign market, 50% of that is IG and 50% of that is high yield. And what's really driving the performance in terms of what I still think is good performance, but what's really driving the underperformance is that 50% of the high yield segment. And obviously with sovereign balance sheets having exploded over the last 3 years, this is a real challenge, and I think Hendrik alluded to this earlier, in terms of either refinancing or restructuring. And that is a problem. And I think it's going to be very hard for a lot of high yield sovereigns to refinance going forward, especially this market persists. And I think that's really the market's a little bit front running that in terms of understanding that obviously inflation's going up, interest rates are going up, risk premium is going up, and you have already large sovereign balance sheets that need to refinance into that. It's a very challenging environment to go into. So if we're looking for positives, that's probably not the place to look.
Thank you so much. One last audience question before we slowly will have to wrap up our panel. Laurent, this one I thought was quite an interesting one. It's because you talked about climate change in the context of what your company does. But this question, which comes actually from our virtual audience, thank you very much for posing it, is the adoption of digital assets, especially cryptos, how does one balance this against climate pledges? I mean, is this something Trafigura is facing? Are you dealing with that?
I think crypto is actually the opposite of what we do. We're rooted in the real world. We move commodities from point A to point B. So crypto, we look at it, but more, observing, trying to assess how it's going to impact our funding needs, but we're definitely not at the forefront of it. I mean, crypto will probably drive more usage of electricity to some extent, which means obviously an impact on commodity demand. But directly using crypto in our business, not so much. It's more about blockchain, having a safer trading environment. I think there's been a lot of discussion around that, which started a couple of years ago, and Singapore also drove the discussions. I think for us, the issue is about balancing flows and the underinvestment we're seeing in the hydrocarbon projects and also minerals. I think just back to decarbonization, we're seeing Europe having huge ambition, and today the EU is announcing a new strategy called Repower EU. It's about accelerating the energy transition. But at the same time, there's a massive reliance in critical commodities from China. If you look at the processing capabilities in cobalt, which is key for battery as well as lithium, I mean, I think it's 70% of cobalt processing is in China, 90% for lithium. There is no refining capacity in Europe. So, and that's critical for electric vehicle, for storage, battery sector, and all the rest. So we prefer to invest in that type of assets than in crypto.
Fair enough. Thank you very much. We're coming slowly towards the end of our session. Just enough time to ask you all one last question. And I thought we could wrap it up, and maybe let me start with you, Kofi, because you've been quite a downer on this panel, I have to say. So is there one really positive thing, a really unexpected bright spot that you either have seen in 2022 or we can expect to see in the rest of the year? Give us some good news before we close this out.
I don't know if I've been a downer. I've just been more, I think realism is how I call it my family. I think that there are positives. I think that actually taking that sensitively now. I think there are positives to see in this in the market. I think if you look at, I spoke to sovereign picture in terms of the 50% high yield, 50% IG, and that's what's driving the performance there. There are other segments, for example, the EM corporate credit segment, which is 2/3 investment grade and only 1/3 high yield. And so there has much less refinancing risk. And I think that's a much shorter duration, a much higher actual spread. So you really have an area where in this kind of environment, you actually probably are supposed to hide there as opposed to in the sovereign market. I think that, that would be the positive. I think I think in this kind of environment, it's a clear positive. If you look back at the last taper tantrum, the segment that you were supposed to hide in was corporate credit, the emerging markets. I think that's true now. I think the fact that we've actually had corporate balance sheets improve since then, and you still have good spreads and much lower default probabilities going forward, it makes it a much easier place to hide, within the segment.
Fantastic.
That was
Laurent,
positive, right?
That was good. I'm glad. Thank you very much. Laurent, what about you?
I think the positive is definitely the acceleration in investment in renewables. The dependence on Russian fossil fuel was a watershed moment for Europe. They're putting in place new plans to accelerate this transition. So you'll see more support for strategic infrastructure projects in energies, in minerals. I think it's very positive. I think it's going to accelerate this transition that we've been discussing among investors, issuers, ESG, but now it's becoming really tangible. And I'm very hopeful about that. And there's so much acceleration in the sector. It's really exponential. And to me, it's just the beginning. And return also probably for investor will go up on that sector, but also in the oil and gas sector, because there's such a deficit of investment that the returns will be too good to ignore.
Okay, thank you so much. Katarzyna, in Vienna, what's your bright spot?
What's my bright spot? So I would also say that it's the acceleration of decarbonization of investments. What we have seen over the last years, we've been the first issuer of green bonds in benchmark format out of Austria, that the production of green loans that are eligible for green bonds has stagnated. Because many companies, especially in the middle-sized companies, they did not see yet the value to do green bonds to transit. And now this will have a push. So it will have a push for the companies. There will be more investments. It will also help us to, as an intermediary, to support that transformation. And this is a good push. And the other one, the bright spot, is the solidarity that I've seen now within our group, helping our Ukrainian colleagues. We have supported more than 1,100 families of our employees to reallocate. We had 200 volunteers driving to the border, picking up people. So we've seen a lot of energy that brought people together. And that's my second, let's say, bright point out of this crisis that have hit us so close and so hard.
Thank you so much. That's a really nice reality check, I think, for all of us. We talk a lot about business, but hearing how you are really impacted from, how you're impacting really people's everyday lives. Wonderful. Thank you so much. Rajan, what about you?
I'd probably say I've got two. The first one is every day that passes, we're a day closer to the war in Ukraine ending. That's going to be a positive for everybody. And then the other one is slightly more theoretical, but I think, we've been in an era of quantitative easing for a very long time, and now we're in a tightening cycle. If we can get through all the challenges we talked about, inflation, interest rates, recession, and that quantitative tightening continues to happen, and we are actually weaned away from government liquidity, then we're finally arriving back at a normal market. And I think that's a positive for everyone, and certainly a positive for, high-performing businesses.
Thank you. Henrik, as our host, you get the last word.
Thank you. So I think across this panel and our audience, and I think at last count we had 7,000 online, one of the common themes is that we are all exposed to credit in some shape or format. We are facing creditors, we're providing credit. And I think the positive that I have is the markets have developed over the last decade in a position to manage that a lot more effectively than ever done before. I agree with Laurent's comments. I think there is pockets of market infrastructure like exchanges that still need some work, and the ability to hedge commodities is absolutely crucial or will worsen the situation around inflation. But generally across fund managers, across banks, across private equity, the ability to manage credit exposure is the best we've ever been at. So whilst we're facing watershed moments of inflation, a war, etc., the ability for the system to manage that and continue to provide credit. Because if we stop providing credit, then we will definitely go into recession or worse. That is real positive for me. So I think with that, our investors also have the ability to move their investments around quicker and choose better places potentially to invest or get returns. So I think we're still in a positive place.
Thank you. This leaves me to thank our fantastic panelists for your great insights. Thank you very much also, Katarzyna, to you in Vienna. Thank you all for joining us here in London today, as well as everyone who is dialed in virtually. Please stay with us, because coming up next is an economic outlook that will look at the opportunities of 2022, but apparently only for the brave and bold. So let's hear all about that. Thank you very much, and goodbye.